20 years ago, people in India would visit small mom and pop stores for every requirement, right from groceries, FMCG products, fruits and vegetables, dairy products to fashion apparels, accessories, footwear, etc. And then we saw a big trend, the introduction of fancy supermarkets. They offered everything right from grocery to FMCG product to fashion apparels and accessories. This trend started with metro cities of India and then slowly entered into the tier 1, tier 2 and 3 cities. Still, a major chunk of retail segment in India is largely unorganized with small mom and pop stores. But today, consumers are preferring supermarkets and organized retail chain for their daily needs. Remember, we are a country with 140 crore population with rising income and spending levels. So clearly the opportunity in organized retail business in India are immense. And that's where two largest business houses of our country are aggressively pushing to capture this fast-growing organized retail market of India. First is Reliance Group with its Reliance Retail chain. However, currently Reliance Retail is not a separate listed entity. And second is the most respected and trusted business house, Tata Group with its retail chain of stores. And in last 8 quarters, the domestic institutional investors have consistently added this Tata Group of company, increasing their stake from 10.03% to 11, then 12, 13, 14 and now 16.11%. Well, the company name is Tata Trent, the parent company of retail chains including Westside, Zudio and Star. Hey everyone, my name is Sahil and this is my Personal Finance Academy. The retail sector in India is emerging as one of the largest sector in economy that contributes to over 10% to GDP. India is expected to become the world's third largest consumer economy in terms of consumption by 2025. Some of the factors that would fuel this growth include increasing number of high-income households, shrinking household size, doubling of consumer class, and growing modern retail across channel. Just to give you an idea, estimates suggest that the share of traditional retail will decline from 85% now to 65 to 70% over the next 4 to 5 years. While other channels including e-commerce and modern trade retailers could corner around 30% share from current levels of 15%. That's double the size in next 4 to 5 years. So the future of organized retail in India is very bright. But it is not a cakewalk to run such retail chains. In grocery, we have already seen the exponential growth of D-Mart in last 20 years, but at the same time, we saw the fall of Future Group. So in this video, I've tried to explain the business model of Tata Trent and its future growth prospect. Also try to figure out why institutional investors are consistently adding Tata Trent in last 8 quarters. So let's try to understand the business model of Tata Trent to get the answers. But before we proceed, this video is only for educational purpose. It's not a stock tip. Alright, let's get started. The history of Trent dates back to 1952. During that time, Indian women were spending precious foreign currency to buy beauty products. So Mr. Jawaharlal Nehru approached J.R.D. Tata to manufacture beauty products in India. And that's how Lakme was born. Lakme even added apparels in its portfolio. However, in 1998, Lakme divested its cosmetic business to Hindustan Unilever and apparel business was merged into a new entity called Tata Trent. Now, if you look at the business of Tata Trent today, it can be grouped into two entities. First is Trent-owned businesses and second is Trent Alliances. Within Trent-owned businesses, its first flagship retail chain runs under the brand called Westside. Westside offers branded fashion apparels, footwear and accessories across segments including women, men and children along with a wide range of home furnishing and decor. Although the major focus is on women products. Please note that Westside offers 100% exclusive retail brand portfolio and has its presence across the value chain, right from design, production, supply chain to stores. Today, Westside has a total of 211 stores in 127 cities of India. Then second chain is under the brand Zudio. In spite of running chains of Westside, Trent realized that majority of Indians are still very price conscious and there is still a gap in fashion industry where people are looking for fast fashion products at very reasonable price. That's where it launched chain of Zudio that offers in-house curated fashion products at very sharp price point. Today, Zudio is the fastest growing retail chain within Trent. It has a total of 326 stores in India. Out of this, 100 stores were opened in FY22 itself. And there are big plans to add another 400 stores of Zudio in the next 3 years. Then third chain is of Landmark Excite that offers beauty, personal care and fashion accessories. It also have Utsa chain that include your Indian fashion lifestyle products and apparel and accessories outlet for women. So that is your Trent owned business. If you look at Trent Alliances, then first alliance is Star Supermarket, which is a 50-50 joint venture with Tesco. By the way, Tesco is the largest supermarket chain of UK. Trent chain of Star Supermarket offers products across your FMCG, staples and fresh products including your veggies, fruits, dairy, etc. The supermarket is a very competitive category with very low margin for retailers, and that's where Star's strategy is to sustain and grow with its exclusive brands where it fetches much higher margin. Today their exclusive brands have over 450 SKUs across personal care, packaged food and home care segment. Company also has an online grocery portal with name StarClick. Then Trent has also allied with Inditex Group of Spain, famously known for its chain of Zara stores in the world. Company has 49% stake in Zara chains of stores in India. Currently, Zara has 21 stores in 11 cities of India. Trent has also collaborated with Massimo Dutti stores, which is also a part of Inditex Group. Basically, the role of Trent is to facilitate the distribution of Zara and Massimo Dutti products in India through its retail stores. In addition, Trent is also making new partnership to expand its product portfolio and reach. For example, it has recently done a 50-50 joint venture with Mass MET in lingerie, activewear and related category. Now you might say that there are already so many organized retail chains today and many brands are launching their own outlets. Moreover, there is stiff competition from e-commerce as well. So how is Tata Trent different from others and what is the moat of their business? I had the same questions. So when I analyzed the business of Tata Trent, I found that it is built around 4 key strategies. First is targeting aspirational women. Be it Westside or Zudio, Trent key target audience is aspirational women, and young aspirational women is a fast growing category. Although it also offers men's and kids apparel just to cover the complete family portfolio. Then second strategy is focus on low cost fast fashion. Company is mainly focused on providing new styles on a consistent basis at a very affordable pricing with limited discounts. Since the styles keep changing frequently and discounts are limited, people tend to buy products rather than waiting for the discount season. This is the exact business model of Zara that made it a multi-billion-dollar company today. Then third strategy is it offers own brands. You won't find other brands like Nike, Levi's, H&M, etc. on Trent stores of Westside and Zudio. They have their own in-house private labels that offer superior product quality at reasonable price. Since Trent owned the supply chain right from your design, production, logistic to end stores, it helped them command a good margin. Then fourth strategy is D2C focused company. The traditional retail businesses were built on B2C, that is business to consumer model that included your distributors that would buy the product in bulk and then pass on to retailers. Distributor would act as a middleman and keep their own margins. However, the new modern retail trade called D2C removes the distributor from the supply chain and directly sell the product from manufacturer to consumer. That's why it's called direct to consumer. Trent does not include any distributors as middlemen and hence focused on D2C business that would help them gain more margins and even pass the product to end consumer at lower cost. So that's a win-win for both Trent and consumers. So basically Tata Trent is building its moat around the supply chain with focus on D2C along with fast fashion products to price conscious Indian consumer at same time offering good quality products. Moreover, the offering completely include their in-house brands that help them maintain the good profitability. As far as leadership of Trent is concerned, being a part of Tata Group, we can always expect top governance with all the required expertise. Currently, Mr. P. Venkat Salu is the ED and CEO of Trent. He joined Tata Administrative Services in 2001 and since then he is part of Tata Group. By the way, friends, now I am also available on Spotify where you can listen to my podcast as well as watch the video. My podcast name is Personal Finance 101 with Sahil Bhadviya. In case you are interested, link is in the description. Now, so far we have discussed the positive side of the company. Let us look at the key challenges faced by the company. So first challenge is availability of good location. For the company to grow, it should be able to identify right locations and it is not easy to find good locations for growth. If they are not able to find right location, it could hinder their growth plan. Second challenge is lack of brand pull. A lot of brand conscious people directly purchase from retail stores like Levi's, Nike, US Polo, etc. Trend brands do not enjoy that kind of pull, so it won't be easy to pull customers. Third is growing competition in D2C space. Today, there are already hundreds of D2C brands in personal care and fashion segment and this category has become highly competitive. Moreover, there's also a lot of competition from online marketplaces like your Nykaa, Amazon, Flipkart, etc. Also in the near term, there's a fall in demand due to slowdown in discretionary spending, although Trent being a value-driven retail chain would not be impacted badly. Now let us look at the company's financials. If you look at the revenue in last 5 years, company revenue has consistently grown from 1,812 crore in FY17 to 2,000, 2,600, 3,400, then fell down due to COVID, but again picked up, and in trailing 12-month revenue stood at 7,388 crore. That's more than 4 times growth in revenue. Company operating profits have grown from 134 crore in FY17 to trailing 12-month levels of 996 crore. That's a CAGR growth of 42%. So company is certainly growing at a very fast rate. And this growth would continue in the future as company is aggressively expanding its business. The reason why I have not shown net profit is because the taxes are very fluctuating, which will not give a right picture. In terms of profitability, company's margins have improved from 7% to current levels of 13%, but ROE and ROCE are on lower side. Simple reason is the majority of capital is currently getting deployed in expansion. So ROE and ROCE would eventually improve once the company moves from growth to mature phase. In terms of leverage, company has a debt to equity of 1.9, which is on higher side. The reason is because retail business is highly capital intensive, and that is the reason it is not easy for anyone to start a retail chain, and that's where the companies with strong parentage like your Tatas have a big competitive advantage. Company is consistently cash positive on operation side. Now if you look at the share price, in last 5 years it has grown from 330 rupee to current levels of 1350. At current levels of 1350, Trent commands a PE ratio of 147. Now if you simply look at the PE ratio, your first reaction would be crazy overvaluation. But it is important to note that organized retail segment where companies are growing at a fast rate by opening new stores can't be compared simply with PE ratio. For instance, in last 1 year itself, Zudio has opened 100 stores. So you can't expect Zudio to deliver high profitability from day one. Currently, Trent is in investment stage, and once the stores become mature, they will add on to profitability. So going forward, company's earnings would increase and that would result in fall in PE ratio. Here one of the valuation parameter you should check is EV to EBITDA. Currently company has enterprise value to EBITDA ratio of 40, which is lower than 5-year median of 55. Here again we don't have any listed peer to do apple to apple comparison. Now if you look at the shareholding, promoter holding has been constant, FI has been a net seller due to macro pressure, but DIs have constantly added stake in last 8 quarter and public holding has reduced in last 12 quarter. DI's consistent increase in shareholding is a very positive sign. Now I was looking at brokerage targets, and recently 3 brokerage houses have given a target on Trent. Motilal Oswal has a buy call with a target price of 1500, SDFC Security has a sell call with a target of 1040, and Axis Direct has a buy call with target price of 1700. Currently Trent is trading at 1350 rupee. So overall if you look at the organized retail market in India, there is immense growth potential. But at the same time, this market is getting too competitive, and that's where Trent's strategy is to focus on aspirational and value conscious segment and offer good quality products at lower cost. Trent is also D2C focused brand and own the entire supply chain with its own set of brands. This makes this business cost effective and sustainable. Considering Trent as part of Tata Group, I have no doubt that Trent is well positioned to capture a good market share in this growing organized retail segment of India. And it seems even the domestic institutional investors are betting on Tata Group parentage and find Trent business promising. Although from valuation perspective, the traditional PE ratio metric suggests Trent being overvalued. But again, we can't just look at PE ratio, as Trent is aggressive growth stage and its EBITDA has grown at 42% CAGR rate in last 5 to 6 years. And considering the future plans, the earnings would continue to grow at faster rate. Now currently Trent commands a market cap of around 48,000 crore, and another retail chain of Tata Group, that is Titan, commands a market cap of 2.1 lakh crore rupees. So the question is, can Trent continue to grow and become the next Titan? I think it is possible. Now tell me, what do you think of Trent business? Can it continue to grow? And is it worth investing your money? I hope you'll find this analysis useful. I'll see you in next video. Till then, take care.